Okay, today we're going to talk about capital structure, leverage, and financial risk. Okay, today, as I said, we're going to look at capital structure, and we're going to first look at the weighted cost of capital, and we'll talk a little bit about leverage and the impact of leverage on financial performance and risk. We'll talk about what's the optimal leverage, leverage representing, as we'll define today, your debt relative to your equity, what's optimal, and we'll also talk about risk balancing. Your reading assignment is Chapter 6, and also today I'm going to mention several handouts, the measures of profitability as a function of leverage, and also there's another one, sample problems using the formulas for the rate of return on equity. Looking at capital structure, a firm or a decision maker of a firm needs to decide on its optimal size and the optimal financing of its assets. The assets are financed using debt to equity. If you wanted to buy a tractor, you would put some of your own money as a down payment into that tractor. That's equity. You'd also go to the bank to take out a loan to help pay for that tractor, and that's debt. So you might have a $80,000 tractor of which you put $20,000 of your own money to purchase it, and you may borrow $60,000 from your debt. So that $80,000 tractor is a combination of financing, including your debt and your equity. Leverage is the debt relative to equity to use the financed assets. If for every dollar that you use to buy assets, if 20 cents of that dollar comes from equity and 80 from borrowed capital, then it'd be 20 divided by 80 to get your leverage, the relative proportion of your equity relative to your debt to finance your assets. So notationally, leverage is just simply debt divided by equity. Now, if you've been in other accounting classes, leverage can come in different forms. You could have debt relative to assets or equity relative to assets. There's different combinations of this to get at this same idea, and the word leverage is simply because you're taking your net worth, your equity, and you're borrowing capital to leverage the size of your business. You can grow in size by leveraging off of the equity that you have. The question is how do we get this optimal mix of debt and equity? Do we have 50% of our assets financed with debt and 50% with equity? Or do we want 20% in equity and 80% in debt? Now, when we ask this question, we can look at it from a firm that has unrestricted access to equity and debt. You can think of a company like Microsoft. It's not unrestricted, but on the other hand, you recognize that if Microsoft, they want to expand, so they want to increase the size of their assets, and they want to finance that through equity, they're going to issue stock. Since their stock is publicly traded, they don't have a problem getting more money that way. On the other hand, if they want debt, they can just issue more bonds. And they have the reputation that they can pretty much seemingly unrestricted in the money that they have access to. Now, if you have a firm like that, a corporate firm that can obtain equity and debt through the stock market or the bond market, then they're going to choose that leverage position that's going to give them the lowest cost of capital. They want that combination. If we look at this, okay, we're talking now about the corporate firm, the large corporate firms. We have this equation. And in this equation, we have this cost of equity capital, this I subscript E, and we have the cost of debt capital, the interest rate, I subscripted D, and then we have this IA, which is the weighted cost of capital, where we have D is equal to debt, E is an equity, and A is an assets. Now, it's weighted cost of capital. You can see that because if we look at the cost of debt, we weight that based on the proportion of our assets that come from debt. So we divide the debt divided by asset to get that proportion. And we weight the cost of equity capital based on the proportion of our assets that's financed through equity. And so thus we have the weighted cost of capital. Now if we look at this graphically, we have the cost of capital on the vertical axis and the leverage on the horizontal axis. Let's start at 0, which means we have 0 debt. Everything is financed with equity at this point that I've circled. And if we look at the cost of equity capital, okay, which is this topmost line, and we recognize, as we've talked about before in this class, that the cost of equity capital is higher than the cost of debt capital because the equity holders are the residual claimants. There is greater risk. We gave the example of Enron, the holders of the Enron stocks versus the bondholders of Enron. The bondholders were paid off before the stockholders. It was the stockholders that lost the most money because they're the residual claimant on the assets. And because there's greater risk, then there's a greater cost than if there's just debt capital. So we see this disparity. Now right here at the point 0, the weight between the equity capital and the debt capital, there's 0 weight on debt, so the weighted average cost of capital is exactly equal to the cost of equity capital. But let's say that we add some debt. Then it becomes a weight between the higher equity capital and the lower debt capital. And that weight, you can see, is right in between here. That yellow line becomes the weighted cost of capital. And because we're bringing on lower cost of capital, you see that the weighted average cost of capital is actually going down, as you would expect. Now another phenomenon happens. After you get too much debt relative to your equity, the lenders recognize then that they're taking on some collateral risk, because then if you have a bad year, they have less collateral to have claim on. So as the debt becomes riskier to the lender is going to increase the rate. Thus you see it's creeping upward. So at some point, as the interest rate goes up, that weighted cost of capital plateaus and then starts to go up as well. And it's right at that minimum point that becomes the lowest weighted average cost of capital, and it becomes the optimal leverage. Because if their returns on their assets are held constant, think of your net present value formulas. If you can lower your discount rate, what happens to the net present value or your wealth? It's going to go up, so your wealth goes up. So obviously, a firm is going to increase their wealth position by going to the lowest average cost of capital. Now let's look at the capital structure in agriculture, where it's more of an entrepreneurial business, where they don't have unrestricted access to debt and equity. We recognize that there's pressure to grow in size in agriculture. There's pressure for a farm firm or a ranch firm to grow. Particularly from your perspective, one of the reasons that you want to grow is to take advantage of your management skills. You may have great skills, and you may be able to even go out and buy 50 acres of land. But at 50 acres of land at a $100 profit doesn't buy you very much, does it? In order for you to have a farm size large enough that's going to provide the income for you, you've got to grow. And in fact, many of you might want to go out and start a farm business, but you're constrained because you don't have the capital to have a size that's large enough to be profitable or functional. The other is to achieve economies of size. Now an obvious example of that, if you had an $80,000 tractor and an additional $100,000 of equipment, and you're only farming 50 acres, you recognize that that equipment far exceeds any money that you're going to make off that 50 acres of traditional croplands. Obviously, if it was organic broccoli or something of that nature, the size dimensions would change. But for a normal cotton farm or wheat farm or corn farm, 50 acres, if you had a full complement of equipment, isn't going to cut it. You're going to have to expand the size of your acreage in order to efficiently use all your equipment. You want to get to a critical size where you have economies of size. Now the problem is we recognize the need to grow, to have an economically viable size of farm. The problem is most agricultural firms don't have access to the equity markets. If you have a family farm, I suspect that you or any of your family members that have a farm doesn't have access to publicly traded stock, meaning they can't go out and issue stock in the South 40 ranch. They don't have that ability. That means then if you wanted to expand, you would have to borrow money to increase your asset base, whether it was buying machinery or whether it was buying more land. But the ability to borrow is limited. If borrowing was unlimited and you could go out and borrow $1 million, you'd be good to go, right? You could go out and buy the land and the equipment, and you'd have your efficient size of farm firm, and then it'd just be up to you to manage it correctly and stay afloat. But you don't have that. Most lenders are going to look at your collateral and your equity that you have to put on the table so that they're not taking the risk of foreclosure or failure. That means it's difficult then to reach an optimal size and optimal leverage concurrently. So you got two things that are going on here. You want to borrow money to increase your size, but if you borrow too much money, intuitively you understand that if you've borrowed a lot of money, you've got to pay it back. And there's at some point there's just too much. So you want to balance on that to have the optimal size and the optimal capital structure. Okay, so if we want to increase the asset base, there's ways that we can do that. One of the obvious ways is over time you can do it through retained earnings. In fact, we talked about this in the first formal class lecture, as we talked about what do you do with your profits. After you pay off the bank and you pay off for your lease and you pay the Uncle Sam and then you pay a little bit for yourself for your family living, then what's left you retain into the business. The more profitable you are and the more frugal a living you have, the more retained earnings you have, and over time you can increase those assets. The other way is to borrow money. But if you borrow money, it's going to increase leverage. The other way is the control of assets by leasing.